The amount of cash flowing out of China into property has halved within a year, but Australia is still the preferred destination for Chinese investors able to get their money out. In its latest report, real estate firm Cushman & Wakefield and Real Capital Analytics, RCA, says mainland China's third quarter total outbound real estate investment plunged 51% year-on-year to $2.5 billion, the lowest total in 14 quarters, or since the last quarter of 2013. The steep fall in investment is the result of tougher Chinese government regulations. Dominic Brown, head of research, Australia and New Zealand, at Cushman & Wakefield, said Australia jumped into first place by overseas destination with $783 million in deals coming in for the September quarter. Dr. Brown said the Chinese government in August ramped up efforts to control overseas real estate investment, issuing Circular 74, slap bang in the midst of the third quarter. This was the second regulation announced in 9 months that sought to restrict outbound investment capital flows, branding overseas real estate investment as a limited category though not prohibited. Chinese investors have deployed a cumulative $1.2 billion in real estate down under thus far in 2017, Dr. Brown said. The United Kingdom and Hong Kong were the second and third most popular countries. While there have been large commercial property deals such as 161 Miller Street, North Sydney, which was bought by the Mayville Group for $103 million, agents are anticipating a decline in activity in the coming year. One of the biggest projects is in Sydney by the Dalian Wonder Group, which is developing the $1 billion mixed-use hotel and apartment towers at Circular Quay. Office investment only accounted for 28% of Chinese outbound real estate investment volume, down a substantial 83% quarter-on-quarter. Chinese investors did not acquire any overseas trophy offices in the third quarter as the sector's investment volume was the lowest total since the second quarter of 2014. And surprisingly, the majority of overseas investment was directed at the development sector, although even the off-the-plan sales for apartments is starting to wane. According to the research, in line with previous forecasts, overseas development sites have quickly emerged as the top asset category for Chinese investors. While the share of investment into this asset category has surged from as low as 10% to 58% since 2016, there has been a pronounced swing in the opposite direction for overseas office investments, whose share over the same period fell back from as high as 71% to 28%. This fall in project marketing has been felt across the real estate sector, with listed agency McGrath saying it has impacted its sales performance. McGrath recently issued an earnings downgrade of as much as 25%, prompting speculation the board could look at privatizing the business. When asked at the earnings update if that was an option, McGrath chief executive Cameron Judson declined to comment directly, but said all options are under consideration. The founder, John McGrath, is the largest shareholder with 25% of the register.